Hello, friends and family, and welcome to Dividend Compounders with Cheese. Today, we are going to be looking at Target Corporation, ticker symbol TGT, to figure out whether or not this is a good stock. Is this a business worthy of putting into our portfolio? So, in this video, we are going to be looking at the intangibles, the finances, and run some valuation models to determine if I had $500, would I buy Target? So Target right now is trading at about $110, give or take. Sometimes it's going as low as $103-ish, but the 52-week low is $102.93, which is only a few weeks ago. So the question is this a value trap or is this a good buy? If we zoom out 5 years, let's take a look at what it looks like. The price that it is today at $110, $105 is the same price that Target was back in about 2019. So we're saying that the business, the operations, and the metrics are worse off than they were in 2019. But anyways, let's take a look at the dividends, because this is a channel focused and appreciative of dividends. The dividend yield right now is 3.97%. If this drops down to about $105, that is probably a even 4% right there. That means for every share of Target that you own, you will be paid $4.40 annually. And the payout ratio is actually very healthy. It's sitting at 60%. So far, so good. Next, we want to be taking a look at the historical PE ratio. The historical PE ratio is going to tell us whether or not currently is it trading at a valuation that is lower than it has been in the past. However, past performance is not indicative of future gains. So if we are to zoom out like 10 to 12 years ago, it does look like Target used to trade at a single digit PE ratio. And then in 2016, it jumped up to double digits, trading at about a 12 PE ratio. And then fast forward, I think when the e-commerce boom started, it did jump up to about a 15 PE ratio, all the way up to about a 28 PE ratio back in January 2023. Today, the PE ratio of Target is sitting at 15. So historically, it does look like it is trading at a fair value. Next up, we are going to be looking at some news articles and current events surrounding Target. And it does seem like Target is under fire as of recently. So this article was posted back in May in preparation for June, which I believe is Pride Month. Target loses $10 billion in 10 days as stocks fall following boycott over LGBTQ-friendly kids' clothing. And they're talking about $10 billion in the market cap due to an extreme sell-off. So the article goes on to say that Target enjoyed its stock value at $160.96 a share. But after a large group of customers decided to boycott Target, I think Wall Street kind of panics and they just started selling it off, and it closed at a roughly $140. And as of right now, it is sitting at $110. So let's look at after the fact of what happened after that boycott. So this article says sales slumps at Target, and I believe customers were also boycotting Bud Light for the same reason. Let's see what the article has to say. Now, this right here is a major call out. Check this out. Target's sales declined over a 3-month period for the first time in 6 years, the company announced. Oh my goodness. I did not expect a boycott to have that big of an effect. The anti-LGBTQ boycott against Target erupted in May over the company's Pride merchandise. And it does look like the company responded by removing some of those items from the stores. I think this is what they mean by you should talk with your wallet. If you don't like something, then let the company know by not buying anything. With that said, check this out. The comparable sales fell 5.4% over the 3 months compared to the same period last year. I wonder what their marketing campaign was last year. I think this year they really emphasized and wanted to highlight Pride Month, but I wonder what happened in 2022. So let's see what the thought process was behind Target's marketing campaign here. Our goal is for our assortment to resonate broadly and to deliver on the Target brand promise. They decided to pause, adapt, and learn. So that's what the store looked like back in May and June. I currently live in Asia, so I don't have access to a Target, but it's interesting to see what people were boycotting. And I promise, if you stick with me, we are going to be running some financial valuations and some models to determine the intrinsic value of Target. And just to benchmark that previous article with another publishing agency, this one is from the New York Times. Target's sales hit by Pride Month, merchandise backlash. So because of that boycott, Target had to unfortunately cut its forecast for the full year. I mean, that makes sense. If your sales fell by 5.4%, obviously you're not going to meet the guidance provided. What's really interesting is that although the sales declined, the company reported higher profit margins. Oh, Target, what is happening here? Let's take a look at this photo of the protesters. Keep Satan away from our kids, boycott Target, save our kids. It's really interesting to see how the consumer's beliefs and perspectives can make a company or a business change its direction or operations. But moving on, I wanted to talk about another company that Target is often compared to, and that is Walmart. And this is what AI wrote. Target and Walmart have different target customers. Target is capturing urban millennials, while Walmart has the audience of parents and retirees. But the key thing here is that although Walmart has a lot more locations and sells a lot more different variety of merchandise, Target has the higher gross profit margin. Target is more profitable per sale, per customer. So Walmart is stronger than Target in dedication to the community, fitting consumers' lifestyles, and ease of return. Now, this one might be subjective, but it says that Target has better parking availability, products consumers would decorate their homes with, and the ability to check out quicker. Walmart is more popular for grocery shopping. That is true. Walmart, believe it or not, has a majority of the US retail grocery market share. I think it's sitting at around like 55 to 60%. That's a lot of people. 6 out of 10 shop at Walmart for their grocery needs versus at like a Food Lion, Albertsons, Aldi. I think of Target as being different to Walmart in so many different ways, right? The way that the store looks, what they sell, and the type of customers that they are targeting. When I was younger, I used to do bodybuilding, and I was a part of a bodybuilding online forum. And a lot of us used to buy our clothes from Target. And I think that's one thing that Target has an advantage on. Target's clothing apparel is just really nice. Like you want to actually buy and wear Target clothes. Anyways, let's go ahead and take a look at this article that's going to talk about ideal demographics between Walmart and Target. So the initial paragraph says that Walmart is the king when it comes to big retail stores. All right, so when we look at the age of the customers, it does in fact look like Walmart is focusing heavily on the older demographics, people who tend to be more frugal or conscious of their spending habits, whereas Target is really popular with the millennials. 128 and 126 on their index measurements. So it looks like if you are a millennial, you do prefer to shop at Target over Walmart. And if you are above the age of 45 to your retirement era, yeah, you do prefer Walmart. Now let's look at the different ethnicities and how they choose to shop. So it looks like if you are African American, you really do prefer Walmart 2-1. And if you're Asian, oh my goodness, you really like Target. But if you're white, it's about split down the middle. Same with if you're Hispanic. So this metric right here is really interesting. Shopper habits. Walmart shoppers tend to visit the store more frequently and stock up on more items than their counterparts at Target. So it looks like people who go to Walmart frequently go every 22 days, whereas people who shop at Target go every 48 days. But look at the difference in how much is in their basket. At Walmart, there's 11 items per checkout. At Target, on average, it's 7.6 items. But even though Target has fewer items in their cart, Look at the average basket cost. It's almost negligible. It's almost the same thing. Very interesting insights. I myself prefer to shop at both retailers. It really depends on what I am looking for and what is closer to me. I don't really have a preference. All right, so that's enough of looking at the intangibles and the cultural aspects of Target. Let's talk about the total shares outstanding. We want to find out if the company is issuing more shares and diluting the shareholders, or are they buying back shares? Buying back is a good thing because less shares outstanding means each share that you own has quality over quantity. So when we do look at Target, it does in fact look like they are buying back shares year over year for the past decade. My goodness, this is a beautiful thing to see. It looks like at the tail end of the Great Recession, Target had 750 million shares outstanding. And when you fast forward to today, it looks like Target has 460 million shares outstanding. So they bought back over 300 million shares. This is a positive and absolute wonderful thing to see as a potential shareholder. The next thing we are going to look at is the free cash flow. Essentially, the free cash flow tells us whether or not the operations of a business is profitable or are they burning cash. And what we want to see when we look at the free cash flow is an upward trend or a consistent free cash flow. Now, when we look at the past 10 years, it looks like Target has been pretty consistent. In 2020, their free cash flow just skyrocketed. In 2022, it did decrease. That is alarming and something that we do want to be wary of. Next, we're going to be taking a deeper look at technical indicators and do an analysis on the stock price movement. So there's a few things that I am looking at here. I'm looking at the stock trading pattern. Is it trading upwards? Is it sliding downwards? Is there a line of support? Is there a line of resistance? And most importantly, what the current relative strength index is. Traditionally, a RSI above 70 means the stock is overbought. Too many people are just piling in. Below 30 means that the stock has been oversold and it might be time to buy. You know what they say, right? Be greedy when others are fearful, and be fearful when others are greedy. And I promise, after we finish doing this technical analysis, we are going to move on to the financial valuation models to figure out the intrinsic price of Target. So when we look back in the past 12 months, it does look like Target is trading about sideways for the past 8 months or so, but as of recently, it is sliding downwards. However, it does look like every time it reaches or flirts with the lower Bollinger Band, there is a line of support and it bounces back up. There also does seem to be a line of resistance towards the upper Bollinger Band. But the most important thing here, as I've highlighted, is the RSI. What we want to look at is whether or not Target is being overbought or oversold. So a good metric is what I've been doing is I take a look at the pandemic sell off, right? When every company was selling off, I take a look at the RSI during that era. So it looks like when everybody was selling at a Target back then, the RSI for Target was sitting at 34.32. So 34 for simplicity's sakes. And when we look at the current sell off, it looks like Target's RSI is sitting at 24, 24.8. Remember what we talked about, right? Whenever the RSI reaches below 30, it means that it is being oversold. And if we zoom back in and look at what's happening as of recently, a few weeks ago, it looks like Target's RSI reached 21. And during that time, the stock price was sitting at about 105, which is pretty darn close to their 52-week low price of $102. And I think it was like 93 cents. Although it does look like Target is going in a downward trend, it looks like that it might trade sideways until it's hit with positive news. Unless, of course, Target has another marketing campaign which causes people to boycott, or they run into some other type of dilemma or problem or headwinds, then I think the company will trade lower. If we do zoom out, it does look like back in 2021, Target was trading at about $250 per share. As of right now, they're sitting at $102 to $105. My goodness gracious, what is is going on, Target? And finally, now let's run through some valuation models to figure out the intrinsic value and to compare it to the Wall Street analyst's price target and to determine if I had $500, would I buy Target stock or not? So the different valuations that we're going to be running through are the multiples valuation, the discounted cash flow, the discount dividend model, and the Benjamin Graham valuation model. So with the multiples valuation, what we are doing is essentially deriving a share price based on similar companies in similar industries. Now, the companies that I chose, it represents an aspect of Target's business because Target is not just a retailer, right? They also have a grocery store, which is represented by Kroger. They also have clothing, which is represented by TJ Maxx. And the main bread and butter of Target is retail. So I compared it to the three big giants, Walmart, Amazon, and Costco. So looking at the PE ratios of these similar companies and similar industries to Target, we derive a median PE ratio. And from that, we are going to multiply it by Target's current earnings per share, which is $7.29. That gives us a multiples valuation for Target of $227.23. When we look back at 2022 last year, it does look like Target was trading at about that valuation. And at their highest, which is roughly 2 years ago, yeah, they were well above that, $261. And it's almost comical because Target is trading at $102 to roughly $105, depending on the day. But remember, past performance is not indicative of future gains. Next, we are going to move on to the discounted cash flow analysis model. Essentially, we are plugging and chugging the free cash flow for the past 6 years to give us an average growth rate of 17.66%. So on average, Target has been growing their free cash flow by 18% per year. However, when we look at the data, it is very inconsistent. Sometimes they grow by double digits, and sometimes they shrink by double digits. With that said, we are going to benchmark what we derived from the data, which is roughly 18%, against the analysts, their growth rate, projected growth rate. They said it was like 18.5%, which I think is really positive. I could, in fact, agree with the analysts, but I like to be conservative and play it safe. So instead of putting in 18.5% right here, I'm going to go divide it by 2 and go with 9%. Now, with that, we are going to calculate the terminal value of the free cash flow, put that in right here, and then look at the balance sheet and plug in the cash and cash equivalents against their total debt, which gives us an equity value of 108,263, and we are going to divide that by the current shares outstanding, which gives us a discounted cash flow price for Target, $234.54. $234.54. That is awfully close to the multiples valuation. The next one we are going to do is the dividend discount model valuation. Essentially, we are going to calculate an intrinsic value for Target based on their dividends. So we're just plugging and chugging their quarterly payouts, which gives us an annual dividend year over year, which gives us this value of 15.11%. That is how much Target has been growing their dividend year over year. However, when we look at the current data, although it does look like Target has been generous with their growth rates, they did slow it back down to a 1.85%. So with that in mind, I am not going to plug in 15% right here for my formula. Instead, I'm going to go conservative and go with 6%. With a 6% dividend growth rate, the intrinsic value that we reach from the DDM model is $233.20. My goodness, this sounds very similar to what we just got from discounted cash flow. 234, 233. I do not want to jump to any conclusions before we do the Benny Graham's valuation model. So Benjamin Graham, if you don't know, was the role model and mentor towards Warren Buffett. So Target currently has an earnings per share of $7.29. The analysts project that for the next 5 years, Target's growth rate will be 18.27%, and the current AAA corporate bonds yield rate is 5.59%. That is absolutely high. When we go back down to normal times, when the federal funds rate is not outrageously high to combat against inflation, let's just take a look at what the intrinsic value of the share price should be. So currently it is $145, but let's plug in 3. Let's see what happens. Oh my goodness. The actual price of Target should be at around $270. But because I cannot tell the future, we are going to go ahead and use what the data says it is currently, which is $145. So the conclusion, is Target going to be a delicious dividend determination or disgusting? So this is the one we just did. Target is $145 according to the Grams valuation. The multiples valuation says, hey, $227. The discounted cash flow valuation, $234. And then the DDM valuation, $233. So what is the intrinsic value for Target? Well, it's $209.99. And remember, I just like saying this because it's comical to see how low it is right now. $102. Its current trading price is around $102 to $105. Let's see what Wall Street has to say. So when we compare it to Wall Street, it looks like the low forecast is $116, which means that Target only has a little bit of growth left within it. The high forecast is $200, but the average is $157.35. As of right now, from its current trading price, a 42% upside. But jumping back to what we reached, it's $209.99. So comparing that to Wall Street, even though I plugged in very conservative numbers, I reached $209. So Wall Street is looking at my number and saying, sir, you are way too optimistic. But I really wasn't. Anyways, let's figure out what is an acceptable buy price with a margin of safety baked in. So right now, I'm just going to go ahead and say that Target is trading at about $105, give or take. Sometimes it jumps up to $110. Sometimes it goes down to at least $103. But we're just going to go with $105. My minimum margin of safety for any stock that I'm looking at so that I minimize and reduce the likelihood of overpaying for a stock is a 10% margin of safety. With a 10% margin of safety, the acceptable buy price would be $188 per share. Right now, $105. So if you want a 20% margin of safety, what you would be looking at is $168 per share, which is a 37.5% delta. If we do want to see what your margin of safety is buying at the current share price, I don't know, let's see, 40%? No. If you buy it at the current price, you get more than a 40% margin of safety. What? Do we think it's 50? Yes, you get a 50% margin of safety if you buy Target at its current share price. I personally think that Target is undervalued right now and the sell-off is temporary. I don't think the leadership is going to steer the ship towards bankruptcy. But from what I remember in the data, it did show that Target in its most recent earnings did have negative free cash flow. So that is alarming, but I think that's also based on macroeconomic variables such as inflation, people being a little bit more concerned about their spending habits, and then also the boycotts. But I think all of that is temporary. I think Target will bounce back eventually. And I think the question is, what is a better company, a better business? Walmart versus Target. Target versus Costco, Target versus Kroger, Target versus TJ Maxx. However, to answer the original question, if I had $500, would I buy Target? In that hypothetical situation, I myself would indeed dollar cost average into Target as it trades sideways. Because by looking at the data and the metrics, Target right now is super undervalued, and the margin of safety at its current price is 50%. A 50% margin of safety is outrageous. Sometimes you're lucky to even see 20% on a good stock. But to see 50%, yeah, I think I'm going to be dollar cost averaging into Target. But I think that's what makes investing interesting, fun, and a little scary because there is the intangibles and those factors that we have to consider, such as, are there going to be more boycotts? Are they going to be closing more retail stores due to loss of profit from theft? See, those are the things you also have to think about. So I think with Target, a dollar cost averaging methodology is probably the most appropriate. Anyways, this has been Dividend Compounders with Cheese signing out. Stay safe, and I hope to talk to you next time.